One of the most important principles of investing is diversification. Diversification means spreading your money across different types of investments, such as stocks, bonds, commodities, real estate, and cash. It also means investing in different sectors of the economy, such as technology, healthcare, energy, and consumer goods. And it means investing in different regions of the world, such as North America, Europe, Asia, and emerging markets. Why is diversification so important? Because it reduces your risk and increases your returns. Let me explain how. First, diversification reduces your risk by lowering the impact of any single investment on your portfolio. For example, if you invest all your money in one stock and that stock crashes, you will lose everything. But if you invest in 100 stocks from different sectors and regions, and one of them crashes, you will only lose a small fraction of your portfolio. The other 99 stocks will cushion the blow and help you recover faster. Second, diversification increases your returns by capturing the growth potential of different markets. For example, if you invest only in US stocks and the US economy slows down, you will miss out on the opportunities in other countries that are growing faster. But if you invest in a global portfolio of stocks from different countries, you will benefit from the growth of both developed and emerging markets. You will also benefit from currency fluctuations that can boost your returns when you convert them back to US dollars. So how do you diversify your portfolio? There are two main ways: asset allocation and fund selection. Asset allocation is the process of deciding how much of your money to invest in each asset class. For example, you might decide to invest 60% in stocks, 30% in bonds, and 10% in cash. The exact percentages will depend on your risk tolerance, time horizon, and financial goals. Generally speaking, stocks offer higher returns but higher risk than bonds and cash. So if you are young and have a long time to invest, you can afford to take more risk and invest more in stocks. But if you are older or need money soon, you should invest more conservatively and allocate more to bonds and cash. Fund selection is the process of choosing specific funds to invest in within each asset class. For example, within the stock category, you might choose a fund that invests in US large-cap companies, another fund that invests in international small-cap companies, and another fund that invests in emerging market companies. Within the bond category, you might choose a fund that invests in US government bonds, another fund that invests in corporate bonds, and another fund that invests in high-yield bonds. And within the cash category, you might choose a fund that invests in money market instruments or a bank account that pays interest. The key to fund selection is to look for funds that have low fees, good performance history, and high diversification within their own categories. You should also avoid funds that overlap with each other or have high correlation with each other. Correlation measures how closely two investments move together. If two funds have high correlation, they will behave similarly and reduce the benefits of diversification. But if two funds have low correlation or negative correlation, they will behave differently or opposite to each other and enhance the benefits of diversification. To summarize, diversification is a powerful strategy to reduce risk and increase returns in the stock market. You can diversify your portfolio by allocating your money across different asset classes, sectors, and geographies. You can also diversify by selecting funds that have low fees, good performance history, and high diversification within their own categories. By doing so, you will be able to double your money faster and safer than by putting all your eggs in one basket. The pitfalls of gambling or speculating in the stock market, such as chasing hot stocks, timing the market, or falling for scams. One of the biggest mistakes that many people make when they want to double their money in the stock market is to gamble or speculate instead of investing. Gambling or speculating is when you risk your money on an uncertain outcome with the hope of making a quick profit. Investing, on the other hand, is when you allocate your money to an asset with the expectation of generating a steady income or capital appreciation over time. There are several pitfalls of gambling or speculating in the stock market that you need to avoid if you want to achieve your financial goals. Here are some of them. Chasing hot stocks. This is when you buy a stock that has risen rapidly in price without doing any research or analysis on its fundamentals, valuation, or prospects. You are hoping that the stock will continue to go up and you can sell it for a higher price. However, this strategy is very risky because hot stocks can quickly lose their momentum and drop sharply, leaving you with a big loss. You may also miss out on other opportunities that have more potential and less risk. Timing the market. This is when you try to predict the movements of the market or a specific stock and buy or sell accordingly. You are betting that you can outsmart the market and beat other investors. However, this strategy is very difficult and often impossible because the market is influenced by many factors that are unpredictable and beyond your control. You may end up buying high and selling low, or missing out on the best times to enter or exit the market. Falling for scams. This is when you fall prey to fraudulent schemes that promise high returns with low risk. These scams may involve fake companies, pump and dump schemes, insider trading, Ponzi schemes, or other illegal activities. You may lose all your money and even face legal consequences if you get involved in these scams. The bottom line is that gambling or speculating in the stock market is not a smart way to double your money. It is more likely to result in losses than gains, and it exposes you to unnecessary risks that can jeopardize your financial future. If you want to double your money in the stock market, you need to invest wisely and patiently, following sound principles and strategies that have proven to work over time.